Good evening, everyone. Welcome to the second half Global Outlook, sponsored by Singapore Exchange and organized by M Investment Bank. My name is Jeff from Retail Marketing. Today, we are glad that able to invite Head of Research from Phillip Securities Singapore, Mr. Paul Chiu, to share us some insight on the current global economy. There will be several key topics that the speaker will be addressing, including but not limited to signs of slowing U.S. consumer and corporate demand, stubborn inflation translate to slowing monetary easing, why Singapore banks in favor, which is the best defensive measure in this turbulent time. Without further ado, let's invite Mr. Paul to start his sharing.
Thanks so much. Yeah, thanks, Jeff, and thanks everyone for joining me. Let me just share my screen. Okay, so for the next 45 minutes, I think I will just run through what we view as our Singapore third quarter strategy, which we wrote a note on recently. Basically, slower for longer. What we're just trying to say is that we think interest rate, and as a result, global growth will also be slower for longer. So in the spirit of generative AI, which is everywhere right now, so I wanted to get a picture of a bear, and because we are a bit more bearish in our posture for the market, but at the same time you're going to get volatility. So we just type in under the Bing image creator, bear riding on a roller coaster, and this is the image we got. So I'll move on to the next slide. So this is just regarding our usual disclaimer. No, these are all our views. We take information from public sources and also do seek advice from your financial advisor on the suitability of these products. Okay, we then, as usual, we will typically start off with a review of what happened in the second quarter, just a couple of slides. Again, the image we took wanted something faster. Of course, the US market is the rabbit, and the Singapore market is actually the turtle, because we will be definitely underperform. Okay, so in terms of the Singapore market, it was in Singapore dollar terms, it was down, I think, 1.4%. But if you want to just have a flavor of some of the large cap stocks that perform or underperform, so for the banks, it was another sluggish quarter for the banks. UOB, DBS, OCBC outperformed mainly because of their dividend yield of coming close to 6%. What performed well was actually SIA, Singapore Airlines, and Samco Industries and Yang Zhejiang. These are shipbuilding companies, and this is because of the strong energy prices. You also get similar performance, I guess, in the YTL power equivalent. REITs actually underperform, I think, in part because the Fed continued to raise rates despite expectations. And what we saw, and some of the REITs here, which may not be that familiar to everyone, but some of the REITs here also raised equity, and that also depressed some of the share prices. Some of the stocks that were the worst performers in Singapore were the electronic names, namely Venture Corp. Genting Singapore also underperformed, mainly because of the big results, in part due to the luck factor that they suffered, and Hong Kong Land were due to sentiment over China. So in terms of the performance, so what we do, this chart basically measures in US dollar terms what was the performance of the Singapore market. So it was down about 3.2 in US dollar terms. REITs were also down. Of course, the biggest performance this year has been the Nasdaq. Mainly, you can see it's up almost 32% Nasdaq Composite Index for 2023. Of course, some of the reasons why Nasdaq did well was you obviously had the AI phenomena, artificial intelligence, the structural story. Secondly, is also the soft landing scenario. I think because the employment data has been stronger than expected, so from worries over recession, I think the market has positioned themselves into a soft landing scenario, where we think the economy will not go into, where market expectations the economy won't go to recession, and it will be almost like a Goldilocks scenario. The other thing was, as you can recall, in March there were at least 3 bank failures, but nevertheless, the banks performed well, mainly because the Federal Reserve injected almost 200 or almost 300 billion of support to the banks, and that's also another reason why the US market has also outperformed. Bonds also did were also weak because of the higher rates, and this is gold. The last one here is just KLCR, just for your reference, but this is again in US dollar terms, so it's not in ringgit terms. Okay, just to get a better understanding, some ask like why the US. So in the US, especially the Nasdaq, so one way to determine how they perform is so for the Nasdaq, most of the gains that you saw in the first half, that 35 or odd percent, was mainly because of a PE expansion. So Nasdaq was already expensive at 27 times, and then the market was still very optimistic on the tech stocks. In part, of course, apart from AI, I think some of the tech stocks also, they also shed a lot of headcount. So there was also expectations that margin has bottomed in the US for namely the FANG stocks, the big tech stocks like Tesla, Google, Facebook. Then even this was despite no earnings per share coming down. In Singapore, it was the opposite. I think the PE contracted. I think there's a bit more negativity or pessimism over the outlook. Even though the earnings per share rose mainly because of banks. One interesting one is, of course, Japan is also another big performer. Just one last slide for us, just to have a quick look. We always like to show this. I mean, not to say like to show, but this is something that we always we show to a Malaysian audience, because I guess one of the attractions for Singapore market is also the Sing dollar. And you can see here just the Sing dollar since 1984. But if you just take the last 10 years, on average, it doesn't mean every year, but on average, the Sing dollar has appreciated against the ringgit around 3%. If you take the last 5 years, it was around 2%. So on average, it's about 2 to 3% kind of appreciation for the Sing dollar. I guess that's something to consider when you are looking at Singapore equities. Okay, so anyway, that's it for the highlights. So I'm just going to run through some of the macro themes that we've been mentioning to our clients, and how we see the global outlook for at least the third quarter or even the second half. So the first theme is that we think inflation is still off the target. So of course the Federal Reserve has a target of 2%, but right now the core inflation or the PCE is still about 4%. So one of the reasons is you can look at this chart. So this is all the inflation. So the important one is, of course, the US. You can see this blue line. We haven't gotten the core PCE one, but if you look at this, it is stubbornly high, even though interest rates have risen. And it's actually even climbing in other countries. Japan continues to climb up. You can also see in the EU, although it's also come off, but it's still at 7%. And in UK, you can see that inflation continues to rise. So our macro theme is that we think inflation is going to be elevated, and it's going to be quite far from the Federal Reserve target of 2%. The implications of this means that the Federal Reserve will want to keep interest rates higher for longer. One of the reasons is, of course, the vibrant labor market. So if you look at the one simple metric, of course, there are many metrics. There's also labor slack. When you look at ratios like vacancies to unemployed, that is also off the record, but it's still far higher than the pre-pandemic. But one easy way to look at the vibrant employment market is you look at the unemployment rate. So in the US, it's trending. Of course, you had this big spike during the pandemic. Then right now, it's at the record lows. Surprisingly, even in Europe, despite everyone saying that Europe always start par growth, but you can see that even then also the labor market continues to trend down, and because of this vibrant labor market is also keeping core inflation, which is, when we say core inflation, it is excluding of energy, the petrol and so forth. And this is mainly because of services. So services is the one that's holding up core inflation. And when you think of services, the biggest input to services is, of course, labor. One of the reasons in the US, at least, why we think employment or employment conditions in the US will continue to be robust. One of the reasons is that when the pandemic happened, I think you will see that they lost almost 9 million jobs, so about 150 million to right here about 140 million plus. So even though you've seen very strong job growth, but most of them was just to replenish what has been lost. So as a result of that, we think labor market will continue to grow, and this will keep the Fed unable to lower interest rates, because the core inflation will remain very sticky. So anyway, there is one theme. We do not want to dwell too much on macro. We'll try to spend more time on stocks and sectors. The other theme is that most of the indicators we see globally continues to weaken. So what we see is growth continues to slow. In the US, you can see from this chart, consumer spending is slipping fast. So this is US retail sales. We exclude motor vehicles because motor vehicles is very volatile. So one of the cleaner numbers to look is what is the retail sales excluding motor vehicles, and in the US, the growth rate now is even it is like 3-year lows. So this is quite a worrying thing. So if you look at this, there's a very sharp deterioration in retail spending. So although the stock market may be robust, but economic conditions, at least consumer spending is slipping. Corporates also pulling back on their spending. So one of the more popular indicators that most economists or investors look at is we call it new orders for durable. I mean, what it means is basically what these are a measure of U.S. corporates buying, machinery, durable goods are not things that last long, excluding defense and aircraft because these are very lumpy. So when you look at this indicator too, again, apart from consumers are pulling back, even corporates are also slowing down. The credit is also contracting. So in the US, loans growth is also falling sharply down. In part, of course, interest rates have also risen a lot. But also, as we saw from the 3 bank failures, banks are also tightening because especially the smaller banks, where they need to protect their deposits. Any signs that there's a deposit flight, these stocks can have this very vicious cycle of the share price collapsing. At the same time, then more and more there'll be more of a deposit run. So most banks need to keep their balance sheet conservative. I mean, excluding the large banks, but at least the smaller banks in the US, you see this phenomena, and that's why bank loans are also contracting. Of course, globally, exports are also down. One of the main ones that we like to look at is, of course, Korean and Taiwan exports. Again, these are also contracting. There might be some bottoming out here, but it will still be sluggish. We think even if there is a recovery, we might see a recovery something similar to maybe 2014, where you have like a 3 to 4% type of growth in exports, rather than the big rebound that you had here, of course, because of the pandemic and what happened here in 2017, 2018. So for us, the global environment continues to be weak. The slippage in the decline in exports may not be as sharp as previously, but we think it will still be sluggish. So that is to give you a sense. So the first theme is that interest rates, inflation is going to be high. Interest rates are going to be high. The second theme was most of the indicators, even coming out from China, which we didn't show, but that is also showing slowdown. So globally, things are slowing down. And the other thing is when we look at Singapore, I mean, not to be so pessimistic, so far all the slides have been pessimistic, but we also beginning to see some signs of creeping in for Singapore slowing down. So again, exports in Singapore no different from what we saw in Taiwan and Korea. That was also weakening. You see this blue bounce here, but actually this is because part of it is we have in Singapore, one of our main exports is pharmaceutical and chemicals, and that's very volatile. So sometimes that can swing like 20% up, 20% down, but directionally it's still down. And electronics especially is like the latest number is down about 20+%. So we're not expecting strong results coming out from the electronics companies in Singapore. But what is strong in Singapore is, of course, tourism. So tourism, you can see from here, the latest number in June, the number of tourists coming to Singapore is doubled. Of course, part of it is the reopening. We are still optimistic of tourism in Singapore and, of course, globally. Of course, in Singapore, you have this particular thing of course, most of us heard a lot of concerts being held here, like Taylor Swift and so forth. So when you speak to hoteliers, they are excited because although these events may not be as big as a F1, but they can last 6 days or 5 to 6 days, and this is almost equivalent to a major F1 event. So, and most of this will attract a lot of foreign tourists. So we think the momentum in tourism will continue, especially when we have a huge number of concerts coming up. I skip a few slides, but anyway, one other thing for us in Singapore is that valuations continue to be attractive. I think the market is pricing in a lot of pessimism. So one way to understand this chart is that this is the PE chart. So this is the forward price to earnings ratios of the Singapore market. And typically when it goes below one standard deviation, it tends to rebound. I mean, or at least the valuations tend to expand. So these are almost like record or decade lows in terms of valuations for the Singapore market. I think for when we look at this chart, almost 40% of this is depending on banks. So a lot of this comes on banks because our major index, 40% of it is actually heavily dependent on banks. So and then because of the strong earnings from the banks, I think that's the reason why the PE ratio is actually contracted. So I'll just move on more on our views on stocks and also some of the sectors that we see in Singapore. So the first one is, of course, banks. So banks continue to enjoy very strong margins. So if you look at the bank results in the last 1 or 2 quarters, their interest income is growing about 40 to 50%. I mean, this is even better than the tech stock these days. And one of the reasons is because the bank margins continue to grow, especially 2022, when as the Fed started to raise rates. So when you look at this chart, you will see the blue line here. So this is the Federal Reserve interest rates. So I guess one unique thing about Singapore is that when interest rates rise in the US, the Singapore interest rates, we call it SORA now, used to be called SIBOR. It's the interbank rate, and where most loans are pegged. So most of the loans are pegged to SORA, especially the corporate loans. You can see that there's a very strong correlation between the blue line and also the light blue line, and the dark blue line. So what it means is that when the US rates spiked up, Singapore banks enjoy an immediate increase in interest rates too, because the Singapore market will also follow. Maybe some other countries may be a bit more dependent on their central bank. So just to recap, in Singapore, we don't have an official interest rate policy. What we do is we mainly focus on the exchange rate. Of course, we might come in to intervene in the local markets, but ultimately we have a exchange rate policy. So the exchange rate policy by default is always to appreciate the Singapore dollar. But of course, depending when there's inflation right now, then they will appreciate it or make it steeper, or they might actually gap up their exchange rate. So for us, we focus more on exchange rate rather than interest rates. So the other point here is that you will notice here on the orange line that, of course, the banks, I think no different from many banks, maybe apart from the US banks, but you will see here for the Singapore banks, their margins will increase whenever interest rates rise. So when the light blue line rises, you will see that the orange line also increases. So just to give a recap, why the Singapore banks enjoy higher margins when the interest rate rise. So the 2 biggest assets that any bank would have, especially in Singapore, is that I think maybe 80% of their to 90% of their loans are variable rate loans. So unlike in the US, some of these are locked in. So when interest rate rise, all the housing buyers, all the corporates will of course get a notice on the bank, say that, hey, your interest rates has risen. The other strength of the Singapore banks is CASA. So about 40 to 50% of our deposits are CASA, which is current account, savings account. So these are zero interest rate deposits or loans. I mean, deposits is a nicer name. Rather than call them loans, we call them deposits. But so these are the 2 biggest advantage they have. So with all this risk-free money now, with the huge amount of CASA, and then with the ability to immediately price higher, so their cost is almost the same because most of their cost is CASA. But at the same time, they can raise their pricing, which is the loans that they charge home buyers or corporates. So that's the reason why the orange line will rise, just in case anyone is not clear why the bank. So the banks, you can see that we still expect margins to remain stable and not to, although it will be weaker than before, but we are still not expecting a major collapse in bank margins. But nevertheless, the phenomena here is that in terms of share price performance, even though the banks have announced record earnings, the share price has actually moved sideways. So if you look at this chart, so this is we just took DBS. I mean, they more or less move the same in terms of the directionally. So you can see that the net profit for DBS and the share price, of course, will move along when earnings rise. Of course, the share price will also rise. But what we saw here was that even though earnings continued to climb up to record levels for DBS, the share price has actually moved sideways or weakened. I think in part mainly because investors are still unclear of the net interest margins for banks because they think that interest rates have most likely peaked. And also they think that because interest rate might come down, then the banks will not be earning as much. So for us, as we mentioned, our macro scenario is that interest rates won't collapse, but will be moving sideways or higher for longer, and this will benefit banks. Second thing, the one negative for the banks is that loans growth is contracting, which is not a good sign for the economy in general. But you can see that loans contracted, and loans usually contract when you are in recessionary conditions, like in 2020, and right now it's also contracting in part because of the high interest rates, and of course, no slowing economic conditions. Okay, then the next one is REITs. I think I might be jumping around here, but REITs is we are overweight on REITs for mainly two reasons. Mainly because we think although interest rates have peaked, they were still high, but we think with the more stable interest rates, they will actually help the REITs. And REITs are now the dividend yield for REITs in Singapore at least about 6%. I mean, those with low, Singapore assets is about 6%. We think it's attractive considering number one, because economic growth is slowing down, and number two, although rates on interest rates we don't think are coming down fast, will not come off immediately. But if they peak, what it also means is that long duration assets, the ability to buy assets that can generate long attractive yields for long periods of time will be favored. So that's why we like REITs too. This is just a chart to see are they overvalued or undervalued, and right now they are like fair value at 300 basis points above. I'm going to rush a little bit. I'm worried about time. This is just to show you that we're not expecting any strong dividend growth for REITs because of the interest rates in. Okay, sorry for that. I think there was a bit of a disturbance. Let me continue. Apologies for that. Okay, let me just move on without taking too much time. Sorry for the disruption there. So in terms of for property, what we're beginning to see now, the property prices in Singapore has started to stabilize. In part because there was an increase in ABSD, and then as a result, there's cooling measures. There was another round of cooling measures where especially hit hard was the foreign buyers, where their stamp duty has risen from 30% to 60%. So that's why we are neutral on the property sector. One thing you'll notice is that the authorities will always come in to raise stamp duties whenever there's like a double-digit increase. So whenever there's a double-digit, like 10 point, almost 11%, we got in December, we had one round of cooling measures. Then after an increase of 11%, actually this is not May, it's actually April, you'll see that another increase in ABSD. So whenever prices rise too much in Singapore, the authorities will come in to impose cooling measures where they raise the stamp duties. So right now, if a foreigner wants to buy any property, they have to pay additional 60% in terms of their stamp duty or taxes. But nevertheless, despite the imposition of cooling measures, you will see that the take-up rates continue to be strong. Like the last two launches in Singapore was up almost 50% take-up rates, and a lot of it is bought by Singaporeans rather than foreigners. First-time home buyers were not affected by the cooling measures. I'm going to skip this. I'm just worried of the time. Okay, so anyways, for conglomerates, one of the best performing sectors in Singapore has been Sembcorp Industries and also Keppel Corp. One of the phenomena happening in Singapore is that there hasn't been any new, because of the lack of new capacity being built, because there was a lot of losses faced by the power companies in the last 5 years before the pandemic. There's been no new capacity. Any new capacity is only coming in 2026. So as a result of that, the power companies has been able to enjoy more and stronger and stronger spark spreads. So what you see here is that the continued strength in power prices, especially during the pandemic. That's why you saw very strong growth and performance by a lot of the conglomerates in Singapore. In terms of semiconductor, we think it remains weak because during the pandemic, so this is a foundry capex. So this is a capex spent by TSMC, Samsung, Micron, Hynix. So for Singapore, we are very concentrated on semiconductor equipment makers. So some of the companies in Singapore, like UMS, AEM, most of their customers, or even Franken, most of their customers are like Applied Materials. They are equipment makers to foundries. So this is a proxy to the equipment that's being bought by the foundries. Like they could be inside here. Of course, there's Applied Materials. There's an ASML machine inside here. So, but we think in 2023 and 2024 there was a big slowdown. So we think cyclically it will be soft in 2023. A rebound maybe we think will be at least early 2024. Why we say structurally the semiconductor stocks in Singapore look attractive is mainly because the supply chain is shifting out of China, and a lot of it is coming into Singapore, especially semiconductor, and of course in Malaysia. So a lot of these listed companies, they are getting new customers or new programs, and in part it's also because they are spending more in their capabilities. So of course they're also moving up the supply chain ladder. Like for instance, ASML is actually moving some of their facility out of Europe, expanding into Asia, because they just, even in Europe they also lack enough capacity, so they're also coming to Asia, but they don't go into China. They move mainly into Southeast Asia. For telcos, so telcos of course structurally weak. I think probably not only unique to Singapore. So for telcos, this chart basically just to say that it was happy days for telcos. Now 2008 to 2016, when we had the launch of 3G, then with the launch of 3G and almost the launch of 4G was still fine, but when the arrival of TPG, which was the fourth mobile operator in Singapore, and of course with the introduction of WhatsApp, and where where there's the loss of SMS revenue and so forth, you can see that there's been a major derating of mobile operators' earnings. So this is the ARPU, basically means the prices for telco. So you can see that there's a major collapse in prices for them. Then after that, it came to this level. Then with the pandemic, there was a major decline in prices, because roaming revenue is the most profitable part of a mobile operator's business right now. It's almost pure, everything is virtually pure profit. So we're just getting a small rebound from now. So for us, we are neutral on telcos. Maybe 2024 might be a bit of a more interesting period for them, where there'll be more of the non-telco business is the most exciting part, where they might be divesting some assets, or maybe some of their other businesses might be turning more profitable, can be cybersecurity, or they might be listing some of their data centers or selling some of the assets. So I think telcos is more a 2024 story. I'll move on to healthcare. So in Singapore, there's a bed crunch in Singapore, especially in the public hospitals. But as a result of this, the authorities have created temporary hospitals, in layman terms, because a lot of the patients were staying, not say were staying too long, but they stayed longer than expected, and although they did not need such intensive care by doctors and so forth. So the authorities created this called transitional care facility, like a temporary hospitals that would house these patients before they eventually get discharged and moved to their homes. Otherwise, they'll be taking up too much of the hospitals, although they don't need such intensive care. They don't need doctors to be monitoring. They're just actually virtually just using up a bed, in a nutshell. But why this is important, that's why we saw in Singapore a lot of the hospitals did very well, because all these were set up, and they had a lot of good margins of contracts with the government hospitals. Okay, I will try to spend more time on some of our stock picks. I have like 15-20 minutes. So this is our own model portfolio. We usually show this. This is a very we try to make it as conservative as we can, with a lot of dividend yield and so forth. So for us, we will usually do quarterly changes. We call it absolute 10, maybe because it's just 10 stocks. We will go for yield, we'll go for growth, and some of the re-rating. What dragged us down this quarter or last quarter has been some of the property names because of the cooling measure, and of course that hurts city development, the largest one of the major property developers in Singapore, and also the weakness in China has also affected another stock that we like, which is called Capital Land Investments Limited. We took out DBS and then we added Thai Bev because of the valuations. But I'll just run through all these stocks. This is just for reference in terms of we just track our historical performance of our model versus the index. So one of the stocks we like is Thai Beverage. I will just give a big background because not many, in case anyone may not know. So Thai Beverage they own the Chang beer, of course, but that is a very small profit contributor. Most of their profits, maybe 80%, comes from rum, which is like a spirits business, which is a sugarcane rum that they have like a 90% share in Thailand. So most of the earnings there. So the attraction for that is that they are trading around 12 times PE. And you can see from the PE ratio, this is record low. This is even lower than the pandemic levels. Likewise, for the share prices, even dropped back to the pandemic lows. So one of the reasons why it dropped so sharply was because the post-elections, number one, post-elections was because the new the supposed new opposition party, which may or may not be elected, the Move Forward, wanted to open up the alcohol industry. By opening up, what they meant was actually to introduce more competition. That means to allow small brewers to enter the market. For us, we don't think it's a major threat. I think for Thai Bev, they have I think 400,000 points of sales in Thailand. So they really have a very strong distribution network. I think so. Number two, so we don't think, even though they do open the market, competition can actually take much share from them. And then number three, some of the opening actually allows beers to be sold online. I'm not sure that's going to happen, but that was some of the proposals, because once you are opening up means everything is up for sale. You can buy liquor online, and you can extend the operating hours another, I think, 2 or 3 hours more, because there are certain periods in Thailand where you can't buy alcohol. But that hurt the stock quite sharply because of the politics. And of course, there's the only one risk that of course investors will be taking is, if there's no resolution to the new government and there's any protests. But I think these are risks that as an analyst we can't really defend much. All we can say is that there have been protests the last couple of times, and so far at least the police or military there has been able to manage it well, I guess. But for us, it's mainly a valuation play. Some of the consumer stocks in Thailand are trading like 20 plus times, but this is about 12 times PE. The other one we like is ComfortDelGro. I think those who follow our recommendation will know that this has been a stock that has disappointed us. So for ComfortDelGro, they own three things. So they own a bus operator. They are a bus operator. They are a taxi operator in Singapore, and one of the largest taxi operators in the world. And the third business that they own is also running the train system. So of course, like, why own a taxi is probably not the sexiest business to own. But what has happened is that when the arrival of ride-hailing companies like Grab and even Gojek in Singapore, you can see that the taxi business has taken a sharp hit. You can see that the Comfort's fleet has declined from about almost 16,000 plus to right now about 9,000 plus. But what we do see is, so this is the year-on-year growth. What we do see is that there's some stability occurring for the fleet. So that's the first positive. The second thing is, right now it's not about the fleet. Now there's quite a big driver shortage out there. That's why even some of the ride-hailing apps want to work with Comfort. So ComfortDelGro has also priced up some of the taxi rentals. Recently, they priced up the taxi rental by 5%. And they are also moving their model, the taxi model, more into an app model. So they're almost becoming like another Grab in terms of like you can actually book your rides through the app. So, and also rail traffic is also rebounding at 30+%. So, and yeah, I won't go into too detail, but these are some of the reasons why we like the stock. As you can see from the chart, there's a bit of stability, and also There's also a balance sheet story to this. Pre-pandemic, they had net cash about 70 million. Then right now, their net cash is almost about 700 million. In part because they cut down a lot of capex. As you can see, they don't need so much taxis. So there's also a huge balance sheet story behind it. I'll move on to Propnex. So Propnex is the largest real estate agent in Singapore. I think almost 10,000 agents now. So one of the strengths of the agency when you're huge is that if there's any new launch of property launch in Singapore, usually only 3 or 4 developers get it. So for them, they have like a 40% market share, which is very rare to get any industry where have such a concentration. And they're also paying like a 7% dividend yield. Of course, there could be volatility in the volumes, but I think they can the dividend yield of 7% can sustain because they are paying out 50 million in dividends and they got like 150 million net cash on the balance sheet. The other one we like is SGX. So SGX is not about the volumes in Singapore. Equity market is doing well and there's a lot of volume. Instead, there's the opposite. There's also hardly any listings. So of course, then the reason is why do we like them? So we like them because of their collateral balance. They as a exchange, especially on the futures and derivatives part, they actually collect collateral balance. I'm always getting this number wrong, but I think it's about 7 billion in collateral. So when the clearing members trade with SGX, they have to put deposits and so SGX will earn a treasury income, which is a fancy word for interest income. So you can see that the average collateral balance is here is about 7 billion here. So I didn't get it wrong. So you can see that when the last time treasury income was up was FY20, treasury income for them was 135 million, which is about 30% of the earnings. And that was when interest rates are, I think, maybe like 2%. And then now that the Fed funds rate is about 4%, we expect their earnings to at least have a 20% jump just on interest income. We've already seen the first half with 73 million of interest income, even though compared to the whole of last year, 50 million. So they've already more than doubled their interest income in the first half. So for us, this is like another story behind the banks. So we think the treasury income will boost earnings for them. The only thing that keeps us away from not making it a conviction buy was mainly because the volumes are still soft for their treasuries, but sorry for their equities and derivatives. The other one that we like, because we still like the hospitality industry, is CapitaLand Escort Trust. So they are mainly a service apartment player. So they have, I think, 105 properties. It's not that I counted here, but I just remember they got like 105 properties. So these are the properties all over. They have like US, Singapore, and we continue to see RevPAR growing. I think the latest number, their RevPAR is still growing about 30+%. So it's one of the few pockets of earnings growth that we still can find in among all the various sectors. So we still like hospitality. So you will later notice most of our stock picks revolve around hospitality. So that's why, and they're paying about 6% dividend yield. The other one that we like, so this we always recommend maybe Malaysian investors that are not that familiar with REITs in Singapore to look at Fraser Centrepoint Trust. They have like 9 suburban assets. So suburban assets in Singapore, think of them like monopolies. So the density of malls in Singapore is about, I think, 6 malls versus the 10 for even in KL. So there are less malls in Singapore in terms of the density compared to Malaysia. One of the strengths of these malls is because they're connected to all the MRTs. And in Singapore, it's almost like a monopoly because within that maybe 3 to 4 kilometer radius, or maybe 2 to 3 kilometer radius, there's hardly any malls. So whether you like it or don't like it, these malls become part of the lifestyle for the community. And also these malls are suburban, so they sell mainly essentials. So their occupancy is like 99%. I mean, like most times, like if it's not 98, it's 99 because these are very well sought after malls and there's no competition. And that's why it's one of the most stable type of REITs. That's why for investors that are not very familiar of Singapore, you're not particularly sure what to buy, then For us, we always by default just recommend a Fraser Centerpoint because the assets are very high quality. You know, 99%. I mean, so it's just how fast they can grow the rentals, and so forth. So that's the reason why we recommend. And this is just the location of their 9 suburban malls. They are virtually you don't see them in the Orchard area, so they're all in the suburbs. And with the RTS, maybe they're also, you know, with the new link between Johor, and this could also help them. The other one that we like, which didn't perform, one of the stocks is a City Development. So they are a property company, property developer. But they don't only have property, they also has again hospitality. So they have like 155 plus hotels. Some of them are managed, some of them are owned. So 40% is owned, and then about 45 is managed. So again, we also like them because of the rebound in hospitality business and globally. The other thing that is also then they have also a portfolio of properties, about 2,000 units to launch, and they also have fund management business. So what they have is this is something new for them. So this is not something that they have grown very strongly, but they have like offices. They have also this very unique asset. It's called PRS, but basically it's rented housing in the UK, Japan, and Australia. So they virtually build a apartment block just to rent out. So it's like multi-family in the US and so forth. And they have EPSA, which basically means student dorm. Likewise, they're building they're starting to build up a fund management business, and hopefully they can list all this, and then there will be another revaluation, because once you have fund management, they can value it at a PE ratio rather than. So these are target price. Their RNAV is actually $16. So they're actually trading at a 50% price to book. Yeah. So one of the reasons too is the attractive valuations. Okay, this is the ultra complicated, but this is a capital and investment. So just ignore this part here. Focus on this part. Just that we couldn't find one that could represent all. At the same time, we didn't want to shortchange. And so basically, this company has 2 parts. They have a fund management business. So they manage it into a mall or office integrated development. Then one that's is stable, they already make money because they built it up, they rented, there's income from it. Then they will just sell it into a fund. Then once it's sold to the fund, they will also still manage the fund. They will sell it. Sorry, they can sell the assets. They'll make money after owning it. They'll sell it to the fund. So even after selling it in the afterlife, we like to call it, they actually still can manage it because it's part of their assets. So they can be private funds, or they can be some of the REITs that they manage. They didn't do well because interest rates were rising very sharply last year, and then China was locked down. So quite a number of their assets is in China. So you can see 36% and even 32%. So that is why with China brought them down. But with the reopening, then I think the outlook is better right now because for their operating assets and their ability to launch more funds. Keppel Corp is another one that we also like. So Keppel Corp is they are one of the best performing stocks the last 1-2 years, mainly because they were divesting. So that's why after that, a lot of the GLCs or government-linked companies in Singapore are starting to do this monetization. I guess you're also beginning to see this within some of the Japanese company. So this is called value accretion, because no point being deep discount, but you're not monetizing the assets. So Keppel Corp did very well because they monetize a lot. So a lot of the assets they still have some to monetize. So they are going to sell some of these assets and convert them into an asset management business. And that's the reason why one of the reasons is that they are still monetizing. And then once you become a asset management company, you won't trade at most investors will give them a price to book valuations. But when you have an asset management company, then most investors will value it at price to earnings. Sorry, I'm a bit jumping here because I just want to leave some time for Q&A if there's any. So I'll just move on to last 3 stocks. These are some of the initiations. I know we cover almost like 40, 50 stocks in the company, but I'll just go through some of the recent initiations we did. The one that had a lot of pushback was, of course, SIA. So SIA did very well, so we came up with a reduced rating. Obviously, the company didn't like that too. But so one of the reasons why, so three reasons why we are a bit negative on SIA is because the yields are doing very well. It's a bit hard to see here, but they're doing very well because the competitors, number one, especially Cathay Pacific and the Chinese competitors, haven't been able to push out new capacity. And Singapore, thankfully, with all the government support, they managed to recover their capacity much faster than competitors. But we worry that there's a catch-up phase and this will affect their yields or margins. So that's why we think that's the one pressure point. Second pressure point is the cargo that has done very well for them. You can see here the pink line, but now that cargo is collapsing very clearly, I think they are down almost double, mid-teens, the most recent number in Changi. So that is also going to put pressure on their earnings. Not to mention the balance sheet will also be affected because now they have to go back into they are entering into a capex cycle to reinvest into planes, and also they recently bought into Vistara, Indian Airlines, and they have to also plow some money in there. And Vistara is loss making, and the valuations now is trading about 1.3 times book, which we think is high compared to historically they trade about 1 time book. Okay, we have the one that we like. We have sets, but I won't run through that unless there's questions. In view of time, the one that we initiated we like was Securities. So they are paying almost a 10% yield. So this Securities is an outlet mall in China. So the two reasons we like it is that there is actually guaranteed income for them. So even though if rental sales for whatever reason just disappears, they will still get a base dividend yield of 5%. The remaining yield you get is from tenant sales. So they are outlet mall, and in China, although they might be slowed down, but you're still going to get a big bounce. As you can see here, the tenant sales was weak because of because of all the lockdowns. So we expect a rebound. So in the first half, there's already like I think 16 to 18% rebound in tenant sales growth. So you have the recovery and the rebound. And secondly, in China, because of the weak economic conditions, a lot of the shift in spending has moved more into outlet malls. So that's the reason why we like that. And why we also like that is thematically, once consumer sales are up, you can cash out as an investor rather than you play any of the other consumer names where you get earnings growth, but you may not be actually getting dividend growth. So that's why we like Securities. Okay, I think I'm going to just end it with a conclusion. So we think if there's going to be sticky inflation, and global growth will be longer, will be longer than expected. And then what we like is hospitality and China, and Singapore is still in the stable shape, although it's weaker, but it's still stable. For us, we are focused a lot on dividends just to shelter out as we face this upcoming slowdown in global growth. Okay, so I hope everyone catch up. I'm sorry if I speak a bit fast. If there's any questions, feel free to raise them.
Thank you, Mr. Paul. Before we go into the Q&A session, let me steal some time for advertisement. Thanks to the Singapore Exchange support, we have an upcoming campaign whereby if you trade any counter listed in SGX between period 1st August and ends with 31st August, you and your partner may be invited to the dinner in one of the renowned Japanese restaurant, omakase style. There will be also some brokerage rebate and lucky draw where you may win some cash prize. So if you do not have a share trading account with us, please contact us. So we will begin the Q&A session now. If you have any question, please drop them in the chat box. Okay, Paul, I see some question from the chat there. Is it possible to get the research report for all 10 of the stock?
Yeah, I think because it's an mBank event, so do reach out to Jeff. Then I think I will try. Then we'll probably link it up for you. So yeah, we do have reports on all the stocks. So for us, we only put them in the model portfolio if we have coverage on them. Yeah. Okay.
Okay, KX, I will post our email here. So please email us for your request. Then we will catch up with Paul to get the report that you wish to have. Thank you, Paul, for the research report. So the next one will be the Fraser Centrepoint is recommended for dividend and not for the capital play. Would you also recommend Cap Infra and Netlink NBN for the same reason?
Yeah. Okay. So for capital infrastructure, we don't have coverage, so I don't have coverage yet, I guess. But so I can't really comment on that. But for Netlink, where I do have coverage, I think if I had to buy, I'd rather still buy Fraser Centrepoint, because firstly, Netlink is actually if you look at Netlink, they're actually a business trust. So what they pay out as dividends may not actually come up totally from operating cash flow. So they can actually pay out dividends from raising loans. So that's something you have to be mindful of. And I think at least for Fraser Centrepoint, you can still get tenant growth. Unlike for Netlink, there isn't much growth because everything, all the rates. So for those who may not know, sorry, Netlink is the fiber. There's only one fiber provider in Singapore. So all our homes, all the households, even for me, we may connect to a telco, but the telco will use Netlink's infrastructure. So Netlink owns all the fiber in Singapore that's connected to all the homes. Because of that, they have no control on pricing. The pricing they have to discuss with the authority. So that's why, for us, we would rather prefer Fraser Centrepoint. And the last thing is that for Netlink, they managed to hedge out a big part of their loans, almost at 1%, which is an amazing number. They hedge it out at 1% because Netlink is virtually like a quasi-government at 1%. So you will only see, so they don't have much of a headwind from interest rates only in 2026, where then you get an immediate hit to earnings. Whereas as Fraser Centrepoint, they're already taken on all the interest rates. So at least you don't have to worry there's going to be a drag on interest rates at the later part because they've already taken up. So that's why we think, for me, and you're still underlying owning a real estate compared to Netlink, which you're owning the fiber cables. So I just intuitively that kind of makes it a bit more attractive, I guess. Yeah.
Thank you, Paul. Next question is, with Singapore aging population, do you still think property sector still good to invest for long term? Kindly comment on the property sector in Malaysia as well.
Oh, okay. For Malaysia, I can't say anything. I guess the only thing I can say in Malaysia is that Singaporeans are maybe excited about because there's a new link, right? There's a new rail link between Johor and Singapore, Woodlands. So everyone is kind of excited at the property surrounding the Malaysian side of the RTS. But anyway, that has nothing to do as an analyst. I mean, I don't cover. But I guess for the aging population, yes. But at the same time, I think, although it's not there's no official news or anything, but we think the authorities will be raising the population fast. I think we have our white paper where I slipped my mind the numbers. So we were supposed to hit like 6 million or even 4.9 million now. I think we are like 4.6 in terms of population, excluding foreign population. So Singapore is actually behind schedule in terms of the population targets. And our infrastructure is built for almost 6 million. Sorry for the numbers, it might be a little bit off, but what we're just trying to say is that Singapore has built up a huge infrastructure. They actually announced it. This infrastructure is meant for so much, and the population is this low. But I'm not so worried about the property sector because even though there's even though they increase stamp duties, you can see that the demand is still very strong. So aging is not really, and in Singapore, we're not talking about thousands. So in any year, we're talking about 8,000 units. So we're not talking about 50,000 or a huge number. On average, the new launches are only about 8,000. And household formation in Singapore is about 20,000. So these are not like very huge numbers that we are dealing with. Yeah, and just imagine, even at such if you're buying the second property, your stamp duty is 20%. So you can imagine, even if they were to tweak it down, there will be a spike in demand. It's not about the demand; it's more about controlling prices, speculation that they're worried about. Yeah. Okay. Oh, sorry to. Yeah. Okay.
Okay. Next question is, in lieu of SIA, Would you recommend SIA Engineering for exposure to aviation?
Oh,
Aviation.
yeah. So sorry for this. I'm not very familiar. I probably don't have a good response for that part, the SIA engine. I have my own views, but I don't think it's accurate. So we don't have any coverage. So that's why I'm a bit hesitant to answer that. So sorry for that. I will have to skip that. Yeah.
Okay. Next question is would like to know how's the business in REITs at SG moving forward with the federal hike.
Yeah. Okay. So what is happening with the REITs now is that, like I mentioned earlier, most of the results you will see them. Just example, so you will see the revenue growth, like rental growth, maybe up 6-7%, but the distribution will be down in general, maybe 4 to 5%, or some less. Mainly because interest expense took up most of the growth. So you're going to see this situation where they won't be able to grow their distribution income for the next. I think even up to next year, you won't see much growth. But at the same time, the prices have already dropped have already dropped quite significantly. That's why most of the Singapore REITs are trading about 6% dividend yield. Those Singapore assets, I'm not talking about those in the US. Those are like, I don't know, 15%, even 20%. But just to look at even though we think there's obviously going to be one more rate hike, I think by tonight, or maybe by, I think we'll probably know the news by a couple of hours time. But I don't think it's going to hurt the REITs because it already hurt them last year, because last year when interest rates already went up about 4 percentage points. So right now, I think most investors are already pricing in that, and it's just a matter of time. It's just about the rental slowly catching up with the higher interest rates. It's just that as that progresses, there won't be much growth. That's all. Yeah.
Thank you, Paul. Next question is will be the outlook for Singapore, Genting, and Venture?
Yeah. Okay. So for Genting, um, we don't cover, but we always advise investors. If people really ask us, we always say, if you really want to buy casino, just maybe Las Vegas Sands might be a better one, because Las Vegas Sands, you're still getting Singapore, and then you're also getting the Macau reopening, and you're getting Las Vegas. So I think Genting results will still do well, because I don't go to the casino, but all the casino companies will tell you that there is a pent-up demand phenomena. So I think Genting Singapore will still enjoy strong growth, because there's this pent-up demand, which I know you'll be like, it might sound a bit strange. I don't know, gambling got pent-up demand. Maybe Genting Highlands, you see that too. But Las Vegas, it happened. Macau, it happened. So I think with the reopening only in April, you could get first half will still be strong, because you get this reopening impact for Genting Singapore. But the problem with, I guess, I'm not sure about only Genting Singapore, is that just that they don't really want, they keep hoarding the cash. They don't really want to pay very attractive dividends. Pre-pandemic, this share price was about 90 over cents. So yeah, it's about 96, 97. So, and I think even they admit that gambling, casino gambling is a matured industry. It's not me. I mean, you can even ask the CEO. He will also tell you that. So you get this big bounce, but again, casino gambling is a mature industry. I mean, the young don't really go to casinos to gamble anymore. Yeah. Okay.
Okay, which sector will have an ample upside for the second half 2023?
Okay, for us, we are a bit more cautious, but actually for us, contrary to the market, we actually like some of the China related names, at least for us. We are still hoping for, because it's so weak that we are just betting on a stimulus. That's why some of the stocks that we even initiated, like Securities, because they are giving us quite a good dividend yield as you wait for improvement in China. So this is our non-consensus view, that because if everything slows down, in general, we still think the China consumer will still outperform the rest. It's not going to be fantastic, but because of the reopening effect, that's our own bet. So that's why we think. Then maybe at the fourth quarter onwards, then the better positioning would be for the electronic stocks, the semiconductor names. Just that we think the second quarter results will still be very weak. So that's why we think maybe at the later part of the year, then to go back into semiconductor stocks.
Oh, I think we missed out the venture.
Okay. What is the outlook for venture? I think it's going to be weak. Yeah, I think most of the electronic companies, apart from S.
Guys, sorry for the delay. I think that Singapore need to improve their infrastructure of the internet. Oops. Oh, I think Paul been dropped off. Apology, everyone. So I think now we have to call it off for this session.
Oh, sorry. I'm so sorry. I'm so sorry.
Okay, you're back.
Yeah, my apologies. My apologies. There's something wrong with my I've been having problems with my webinar. Yeah, I'm so sorry. Yeah, it's not anyone's fault. It's my fault. Sorry for that. Yeah. Yeah. Okay. The chat. Yeah. So
Okay,
for yeah.
last two questions. Do you have any comment on the Singapore office commercial occupancy rate, and what are the thoughts of having those type of risks in the investment portfolio?
So for commercial property, it's more stable. I wouldn't say it's very strong growth because there's the effect of the tech sector, but at the same time, there isn't much new supply in Singapore. So it's just stable in Singapore. It's not like robust, but it is not suffering like what is happening in the US and so forth. So we do have the work from home phenomena, but I think that's normalizing now. So for us, we are looking at maybe mid-single digit kind of office growth in Singapore. So that's why for us, we are pivoting a lot more to the hospitality in the near term, because we see the growth that can outpace the higher interest rates. So that's why we are quite overweight on hospitality REITs. Yeah.
Okay, we're going to take the last question. Sorry, Paul. So the last question is your house view on the counter like Hams Higher REITs and the Ara Hospitality Trust.
For us, yeah, for us, United Hampshire, if I'm not mistaken, is more like malls in the US. They, I think they're like not. I wouldn't call them malls, but they're more like suburban malls, if I'm not mistaken. United Hampshire, that asset class seems to be performing better than the rest. Again, we don't have coverage, so some of these names we don't really have like a very strong view. But I think for them, anything with US has been affected. So in Singapore, a lot of the US related REITs have all been sold down. So I think it also affected United Hampshire, even though I think the portfolio has done well. I think the occupancies are still healthy. So I don't think they're affected by the office.
Okay,
Yeah,
guys.
So
yeah.
Okay.
Okay, guys, we need to conclude the session here. So if you have a further question, please email to us. The email already posted in the chat box. So thank you, Paul, for the sharing. We end the session. Thank you for everyone for joining, and have a nice day and happy investing. Thank you, Paul.
Thanks everyone. Sorry for the technical issues just now. Sorry for that.
No worries.
Thanks everyone.
Thank you.
Thanks for your time. Bye.